Imagine this, you're sitting on your porch in 20 or 30 years, watching the sunset, completely free from financial stress. No bills chasing you, no panic over the next paycheck. Just complete freedom to live life on your own terms. Sounds impossible on a normal salary, right? Most people assume that retiring with millions is reserved for CEOs, tech entrepreneurs, or lottery winners. Here's the truth. They are wrong. You don't need a six-figure income to build wealth. You need the right habits, a plan, and the patience to let time do the heavy lifting. Today, investment. I'm going to break down the real secret to retiring with millions, even if your salary feels average and even if you think your bank account is already maxed out each month. This is about strategy. Everything makes a good investment, smart decisions, and understanding the power of compounding. By the end of this talk, you'll see that wealth isn't about how much you make. It's about how much you let your money work for you. It makes a good investment. Most people focus on earning more. That's what society tells us. Get a raise, get a better job, buy a bigger house. But wealth isn't just about income. It's about what you do with your money after you earn it. And this is where the secret lies. Small, consistent actions repeated over decades can quietly grow into millions. It's not flashy. It's not instant, but it works, and it works incredibly well. Investment. The strategy I'll share today is built on four main principles. Principles that anyone can follow regardless of your income. These are the foundations for a millionaire mindset on a normal salary. Master these and you won't just retire. You'll retire wealthy, confident, and free. Now, let's dive into the four key points that will transform your financial future. ChatGPT said, living below your means is often easier said than done, but it is the single most powerful financial habit that separates those who retire wealthy from those who struggle their entire lives. It's not about depriving yourself or living a miserable life. It's about making conscious choices that prioritize your future over momentary gratification. Every dollar you save today can grow exponentially over time. Thanks to the magic of compounding, and this principle is especially crucial if you are working with a normal salary. People often underestimate how impactful disciplined saving can be because they focus only on income. They think, I'll never get rich on this salary. But the truth is, wealth is more about what you do with your money than how much you earn. The first step in living below your means is to understand exactly where your money is going. Most people have invisible leaks in their budget, small expenses that add up quickly without them realizing it. Subscriptions that are rarely used, daily coffee purchases, dining out multiple times a week, or impulse online shopping. These are the silent killers of financial growth. Start by tracking every expense meticulously. For at least a month, write down every single purchase, no matter how small. You'll be shocked at how much invisible spending occurs, and this awareness is the first step toward control. Investment. Once you've identified where your money is going, the next step is to make conscious decisions about what is essential and what is not. Living below your means isn't about cutting all enjoyment. It's about prioritizing what truly matters to you and eliminating wasteful habits. For instance, instead of buying a brand new phone every year, consider keeping your current device for a few more years. Instead of upgrading your car the moment your salary increases, stick with your current reliable vehicle. These choices may seem small in the moment, but over the course of decades, they can free up tens of thousands of dollars that can be redirected into investments or savings. Strategic saving is key. Simply stuffing money under your mattress or letting it sit idle in a checking account won't grow your wealth. High-yield savings accounts, retirement accounts, and investment accounts are essential tools for turning disciplined savings into long-term wealth. When you consistently save a portion of your income in these accounts, you are effectively making your money work for you. Even if you start small, the combination of regular contributions and compound interest can transform modest savings into substantial wealth over time. To illustrate the power of living below your means, consider a simple scenario. Imagine someone earning a typical salary who manages to save just 20% of their income each month. It may feel challenging at first, but over 10 years, these consistent savings in investment, coupled with modest investment growth, could easily grow into a six-figure sum. Stretch this over 30 or 40 years, and you are looking at millions, all achieved without ever earning a seven-figure salary. This demonstrates that wealth accumulation is less about earning more and more about consistently saving and investing what you already have. Investment. Another important aspect of living below your means is the mindset shift it requires. Society constantly encourages spending, making it seem like happiness and success are tied to visible consumption, bigger houses, luxury cars, designer clothes. But wealth is rarely flashy. True financial freedom comes from invisible growth, the money quietly compounding in your accounts, the investments steadily increasing in value, and the security of knowing that your future is protected. Shifting your mindset from instant gratification to long-term growth is crucial. Each choice to save rather than spend is an investment in your future freedom. Automation can help immensely in this process. Set up automatic transfers from your paycheck to your savings or investment accounts. By paying yourself first, you remove the temptation to spend what you should be saving. Investment. This simple habit can prevent human error and emotional spending from derailing your financial plan. Over time, these automatic contributions, combined with disciplined spending, will accumulate to create a substantial financial cushion and eventually the foundation for millions in retirement. Living below your means also builds resilience. When unexpected expenses arise, such as medical emergencies or car repairs, having a buffer allows you to handle them without going into debt. Avoiding debt is another critical component of this strategy. High interest debt, like credit card balances, investment can wipe out months of careful saving in an instant. By living below your means and maintaining financial discipline, you not only grow wealth, but also create a safety net that protects your financial progress. Ultimately, living below your means is not a restriction. It's empowerment. It gives you control over your financial future, reduces stress, and opens opportunities for investments that grow over time. By committing to a disciplined approach, tracking expenses, cutting unnecessary spending, saving strategically, automating contributions, and maintaining the right mindset, anyone can build a foundation that leads to retiring with millions, even on a normal salary. The key is consistency, patience, and a relentless focus on your long-term goals rather than short-term desires. A good investment. Every choice you make today echoes into your future, and choosing wisely is what sets you on the path to true financial freedom. ChatGPT said, investing early and consistently is arguably the most powerful tool you have for building wealth, especially if you're earning a normal salary. While living below your means and saving diligently sets the foundation, investing is what multiplies your money over time. The earlier you start, the more time your money has to grow exponentially, turning relatively modest contributions into a substantial nest egg. The concept may sound simple, but its impact is extraordinary when understood and applied correctly. Many people delay investing because they feel their salary is too small or they fear risk, but waiting is one of the biggest mistakes you can make in wealth building. The reality is that the combination of time, consistency, and compounding interest creates a financial snowball that becomes unstoppable. The principle of compounding is fundamental. When you invest, your money earns returns, and over time, those returns earn returns themselves. For example, investment, if you invest $200 a month in an index fund earning an average of 8% annually in 30 years, you could have over $300,000, all without earning a single extra raise. If you start just 10 years later, contributing the same amount for 20 years, you'd only end up with roughly half of that. This simple math illustrates the immense power of starting early. Even small amounts, if invested consistently over long periods, can grow into significant wealth, far beyond what most people imagine possible on a normal salary. Consistency matters more than timing. Many people fall into the trap of waiting for the perfect moment to invest, fearing market volatility or economic downturns. This hesitation is costly. Investing regularly, regardless of market conditions, ensures that you are purchasing investments at both high and low prices, a strategy known as dollar cost averaging. Over time, this approach smooths out the highs and lows of the market and reduces the emotional stress of trying to time every purchase perfectly. Investment. The key is not to be perfect. It's to be consistent. Small, regular contributions build wealth steadily and reliably, which is far more effective than sporadic investment. Large investments made when you feel confident. Choosing the right investment vehicles is equally important. For most people, low-cost index funds or ETFs are ideal because they provide diversified exposure to the market without requiring in-depth stock picking knowledge. Investment. Diversification reduces risk while allowing your investments to grow steadily. Retirement accounts, such as 401(k)s or IRAs, are also powerful tools because they offer tax advantages that enhance the compounding effect. By contributing consistently to these accounts, you are not only growing your wealth, but also reducing your tax burden, which accelerates your path to financial freedom. The combination of early investing and diversification and tax-efficient accounts creates a multiplier effect that significantly amplifies your savings over time. Another crucial aspect of investing is mindset. Many individuals view investing as risky or complicated, but it should be approached as a long-term strategy rather than a gamble. Short-term market fluctuations are inevitable, but if you maintain a long-term perspective, the overall trajectory of your investments will be upward. History has shown that markets grow over time. Investment and staying invested through temporary downturns is key to maximizing returns. Emotional decision making, panic selling during a dip or chasing trends during a rally can erode wealth and delay your retirement goals. Patience and discipline are the hallmarks of successful investors, and these traits become even more valuable when starting on a normal salary where every dollar counts. Automation can simplify this process and ensure consistency. Setting up automatic transfers from your checking account to your investment accounts guarantees that investing becomes a regular habit rather than an afterthought. By paying yourself first and automating contributions, you remove the temptation to spend money that should be growing for your future. Over decades, these automated contributions, combined with compounding growth, turn modest amounts into substantial wealth without requiring constant effort or attention. Education also plays a role in successful investing. Understanding basic concepts like risk tolerance, asset allocation, and the effects of fees can dramatically impact long-term results. Low-cost investments, diversified portfolios, investment, and strategic contributions allow even someone on a modest salary to leverage their financial resources effectively. The goal is not to become an expert trader, but to make informed, disciplined decisions that maximize growth and minimize unnecessary risk. Finally, investing early and consistently creates not only wealth, but also financial security and peace of mind. Knowing that your money is working for you while you focus on your career, family, or personal passions is empowering. This approach turns a normal salary into a tool for achieving extraordinary results. The combination of time, consistent contributions, strategic investments, and disciplined patience forms the cornerstone of financial freedom. By starting today, even with modest amounts, you set in motion a powerful process that can lead to retiring with millions. The sooner you begin, the more time your money has to work for you. Investment, making every small step taken now exponentially more valuable in the future. Lifestyle inflation is one of the most underestimated obstacles to building wealth. And it's the silent reason so many people never reach financial freedom, even if they earn a decent salary. Lifestyle inflation happens when your spending increases as your income increases. You get a raise and suddenly your monthly expenses grow to match. You buy a new car, upgrade your apartment, eat out more often, or splurge on luxuries that seemed unattainable before. At first glance, these choices feel rewarding and natural. You've earned it after all. But the problem is that every dollar spent on lifestyle inflation is a dollar that could have been invested, saved, or put to work in a way that generates future wealth. Over time, these small choices compound into a major barrier to retiring with millions, especially on a normal salary. Investment. To understand the true impact of lifestyle inflation, imagine two individuals earning the same salary. One controls their spending, maintains a modest lifestyle, and invests the difference. Nothing makes a good investment. The other increases their spending with every raise and never invests beyond the minimum. 30 years down the line, the difference in wealth can be staggering. The first individual may have millions in investment, fully prepared to retire comfortably. The second may have a significantly higher standard of living along the way. But when it comes time to retire, they may face a financial gap or even struggle to maintain their lifestyle. The lesson is clear. Wealth is built not just by earning more, but by keeping spending in check and redirecting additional income toward long-term growth. Resisting lifestyle inflation requires conscious effort and a mindset shift. Instead of allowing income increases to dictate your spending, you should let your financial goals dictate your spending. For example, if you receive a raise of $500 a month, consider allocating a significant portion, say 70%, toward investments or savings while only modestly increasing discretionary spending. This approach allows your wealth to grow exponentially without significantly sacrificing quality of life. Over decades, these incremental savings fueled by controlling lifestyle inflation can turn a normal salary into millions at retirement. The key is to maintain intentionality with every financial decision. Ask yourself whether a purchase truly enhances your life or simply satisfies a fleeting desire. A new car may feel exciting today, but the money spent could generate far more wealth in an investment account over 20 or 30 years. The difference between short-term satisfaction and long-term financial security is the crucial factor separating those who retire wealthy from those who don't. Millionaires who started with ordinary incomes didn't necessarily live an extraordinary life along the way. They made calculated choices, lived below their means, and consistently invested the difference. It's also important to understand the psychological traps that make lifestyle inflation so enticing. Humans are wired for instant gratification, and society constantly encourages spending through advertising, social media, and cultural norms. It takes discipline and awareness to resist these pressures. One strategy is to create a clear vision of your future life, your ideal retirement, financial freedom, and the experiences you want to have. When you keep that vision in mind, the temporary satisfaction of spending on luxury items fades in comparison to the long-term reward of financial independence. This vision becomes a compass that guides your spending decisions and strengthens your resistance to lifestyle inflation. Another practical approach is to establish strict financial rules or systems. Investment. Many wealthy individuals set concrete limits on discretionary spending, automate investments, and maintain separate accounts for wants versus needs. For instance, investment. Creating a fun money budget allows you to enjoy life without derailing your long-term goals. The difference is that spending is intentional, controlled, and balanced against a clear financial plan. Rather than being an unconscious reaction to increased income, automation is particularly effective because it enforces discipline without requiring constant willpower. Investment. By automatically funneling raises or bonuses into investment accounts, you ensure that lifestyle inflation doesn't erode your wealth building efforts. Tracking progress is equally important. Investment. Many people fail to notice how their spending creeps up over time. By regularly reviewing budgets and investment statements, you stay aware of your financial trajectory and adjust habits proactively. This consistent monitoring keeps lifestyle inflation in check and reinforces positive financial behaviors, creating a feedback loop that strengthens long-term wealth building discipline. Over time, investment. This awareness becomes second nature, allowing you to enjoy life today while securing an extraordinary retirement in the future. Finally, investment. Avoiding lifestyle inflation is not about denial or deprivation. It's about leveraging your income for maximum long-term impact. It's about making deliberate choices to prioritize investments over instant gratification and understanding the profound effect these choices have over decades. The money you save and invest by resisting lifestyle inflation compounds exponentially, giving you freedom, security, and the ability to retire with millions, even on a normal salary. By maintaining discipline, focusing on long-term goals, and creating systems to control spending, you ensure that your income works for you rather than being consumed by temporary desires. Mastering lifestyle inflation is one of the most important steps on the path to financial independence, and it's a habit that pays off exponentially with patience and consistency. Investment. Building multiple streams of income is one of the most effective strategies for accelerating wealth, especially if you are relying on a normal salary. While saving, investing, and controlling lifestyle inflation lay the foundation for financial freedom. Adding additional income sources dramatically speeds up the journey toward retiring with millions. Relying solely on a single paycheck is risky. Economic downturns, unexpected expenses, or even job loss can derail your long-term plans. By diversifying income, you create resilience and open up opportunities to invest more aggressively, allowing compounding to work even faster. This principle has been employed by countless self-made millionaires who started with ordinary salaries. Investment. Demonstrating that wealth is not only about how much you earn, but also about how many streams of income you can cultivate. The first step is to recognize that income outside your primary job does not require abandoning your career. Multiple streams of income can be built gradually and strategically. Freelancing, consulting, investment, part-time side businesses, rental properties, or dividend-generating investments are all viable options. The goal is not necessarily to replace your primary income, but to supplement it. Even a few $100s a month can be redirected toward investments, accelerating wealth accumulation significantly over decades. The beauty of multiple income streams is that they allow you to leverage your existing skills, assets, or time in ways that generate financial returns without being tied entirely to your salary. Side hustles are one of the most accessible ways to build additional income, whether it's freelancing online, tutoring, writing, or offering services in your local community. Side hustles provide immediate cash flow that can be reinvested. The key is to focus on opportunities that scale or can be automated over time. For example, creating digital products, online courses, or monetized content allows you to earn income repeatedly from the same effort. This approach turns your skills and knowledge into assets that work for you, not just hours traded for dollars. The more diversified your side hustles, the more resilient your income becomes, creating a buffer against unexpected financial challenges while simultaneously increasing your ability to invest. Investing in assets that generate passive income is another critical strategy. Rental properties, dividend-paying stocks, peer-to-peer lending, or interest-bearing accounts can provide consistent cash flow with minimal active involvement. While these opportunities may require initial capital, even small contributions over time can grow into meaningful streams of income. For instance, a few modest investments in dividend stocks can yield quarterly payouts, which can then be reinvested to accelerate compounding. Over decades, these passive income streams supplement your primary salary, allowing you to increase investment contributions, maintain your lifestyle, and build wealth faster than relying solely on earned income. Creating multiple streams of income also provides psychological and financial security. When your financial future isn't dependent on a single source, you gain freedom to make smarter, less risky decisions. You can invest more aggressively, take calculated risks, or pursue opportunities that align with your goals without fear of losing stability. This confidence is crucial for wealth building because it allows you to think long-term rather than reacting to immediate pressures. Financial independence is not just about money, it's about the freedom to make decisions without being constrained by necessity, and multiple income streams are key to achieving this freedom. An essential mindset for building multiple streams of income is thinking in terms of leverage. Your time, skills, and assets can all be leveraged to create more value than the traditional salary model allows. For example, investment. Investing in rental properties leverages capital to generate returns, while creating an online course leverages knowledge to earn recurring revenue. Each additional income stream compounds the effect of your other financial habits. Savings, investments, and disciplined spending now benefit not only from your primary salary, but also from the extra income flowing into your accounts. This multiplier effect accelerates wealth growth exponentially, turning a normal salary into a platform for extraordinary financial success. Consistency and strategic planning are crucial. Multiple streams of income are not built overnight, and some will require ongoing effort to maintain and grow. Prioritize opportunities that align with your skills, interests, and resources, and gradually scale them. Avoid spreading yourself too thin. Instead, focus on a few streams that provide reliable returns and can be automated or scaled over time. Reinvest profits wisely, using additional income to further enhance investments and savings. This creates a feedback loop in which every income source contributes to building wealth, compounding over years to produce extraordinary results. Finally, building multiple streams of income isn't just about increasing cash flow. It's about creating long-term financial freedom. Each new stream allows you to invest more, absorb risks, and accelerate wealth accumulation. Combined with disciplined saving, early investing, and controlling lifestyle inflation, multiple income streams become the catalyst that turns an ordinary salary into millions by retirement. The strategy requires patience, planning, and persistence, but the payoff is enormous financial independence, resilience, and the ability to retire on your terms. By embracing multiple income sources today, you take control of your financial future and set the stage for a life of freedom, security, and wealth beyond what a single salary could ever achieve.